Alright, we're working on question number 6 in Lab 9 in 253, or rather in 353. And so we're dealing with a question regarding the revaluation model. And so here we have a large factory building which was purchased in 2010, and at that time they decided they were going to use the revaluation model, and the first revaluation occurred on December 31st, 2014. Then on the next day, January 1st, 2015, after this one revaluation entry, the recorded cost of the building was $1.3 million. The accumulated depreciation was nothing because they applied the revaluation model by eliminating accumulated depreciation. So we're going to do that as well. And so essentially it's like we sold a building and repurchased it at the end of every year. And we repurchased it at the new level. Now, revaluation surplus can only go up. It can't go down to a negative value, so it can only be a credit value. And it says that the balance in the revaluation surplus at that time was $210,000, which would indicate that the total value was $1.3 million, and that was the revalued amount, and the previous amount was $210,000 less than that. So we increased the value by $210,000. So we've got some information here. The company decided on that date, January 1st, 2015, that they were going to use obtain annual appraisals of the property and then revalue it at every reporting period. So we're doing 3 revaluations here for 2015, 2016, and 2017. This property value is going up, except for the first year. It went from 1.3 million down to 1.25, so there's a little bit of a direction change there. So it went down to 1.25 and then goes up to 1.4 and up to 1.6. It says to prepare all the required journal entries for this property for the years ended December 31st, 2015, 16, and 17. And we're assuming that the building is depreciated on a straight line basis over 20 years with no residual value. So we purchased it in 2010. We're talking about the first year of depreciation. So we purchased it in 2010, and at the time that we're doing this first set of journal entries on the 12th of the 31st, or the 31st of the 12th, the 31st of December. Sorry, I'm trying to get my mouse to work here, and my mouth and mouse don't seem to work together. Anyway, the December 31st, 2015, that year, the depreciation is for a remaining 15 years, because we only have the building. We purchased in 2010, so 2010, 11, 12, 13, 14, that's 5 years, so we have a remaining 15 years. You didn't see that, but I was counting on my fingers. So 2010, 1, 2011, 12, 13, 14. December 31st, 2014 was 5 years, and so we have 15 years left. So the first thing we do is calculate the accumulated depreciation on the building. Actually, we need the depreciation expense first, don't we? Let's go all the way down here to depreciation expense for the building, and that amount is going to be 1.3 million, the cost at the beginning of the year, divided by 15 years, no residual value, just a straight line calculation. So we can move that over here, and the other side of that entry is accumulated depreciation on the building. Now we have to do this before we actually do the revaluation, because we need to record the depreciation expense for the current year. And so we can call that to record depreciation, if you like, or you can call it whatever you like. Lyrics doesn't really care, it just wants you to have something in there. Okay, so that's the first thing. Now the depreciation expense is higher than the revaluation change. So it went from 1.3 million down to 1,250,000. So that means that when we take the cost of the building at 1.3 million minus the 86,666.67, the net book value is actually going to be, well, we can do the calculation here, 1,300,000 minus 86,666.67 is going to be 1,213,000. So we want to record the building at an appraised value of 1,250,000, which means that we have to increase the value from 1,213,333.33 to 1,250,000. So the calculation, if we open that same calculation, go to the beginning, we're going to take 1,250,000 minus, and we'll put a bracket at the beginning and a bracket at the end. So the amount of the adjustment is going to be 36,666.67, and the new cost of the building will be recorded then at 1,250,000. So that means that we have to increase the building by 36,666. So we're looking for a building here. There we go. By that amount, and then of course that's an increase in the value of the building. So we have a revaluation surplus that is going to increase by that same amount. So it was $210,000. Now it's going to be $246,666.67. This is just an account that we maintain in essentially other comprehensive income in the shareholders' equity. Actually, they said something about that in the information up here. Also assume that the company does not make annual transfers from the revaluation surplus account to retained earnings. Excuse me. So they keep track of the revaluation surplus, and they don't actually transfer it into retained earnings. Okay, so that is to record at 1.2 million or some other such description. So those are the first two things we have to do. And then of course it says that we apply the revaluation model by eliminating accumulated depreciation. So this accumulated depreciation we have here, it's got to go. We'll just grab that number, drag it down here, and grab that description and drag it down here. Grab that description and drag it down here. And the other side of the entry is to the building, because we're essentially offsetting those two and re-establishing the cost at the new cost of 1,250,000. So if we take the building value of 1.3 million and add the 36,666 and then subtract 86,666, we come up with 1,250,000. So that is to eliminate AC DEP, like that. Okay, so that's the first entry. Whoops, I'm not quite sure what happened there. Now, the next year, it goes to 1,400,000. So we have to do the same things once again. So we can just drag the 31s and bring them all the way down here. We can also grab the same accounts, because the same accounts have to be used here. Oops, that's the wrong one. Oh, that's bad. Did you catch that? I just put that into there. So there we go. A little risky there. Okay, so make sure you drag and drop to the right place. Okay, and then the building. Well, actually, we're not sure whether we have a revaluation surplus at this point. So we'll have to do that calculation. But let's, since it's going up in value, pretty good chance. It went from 1,250,000 up to 1.4 million, according to the information up here in this little table. So pretty good chance it's going to be revaluation surplus as well. And the building will have to be offset by the reduction in accumulated depreciation. And of course we're going to record it at a different amount, but basically all the pieces are the same. The calculations are going to be different. So we start with the fact that we recorded at 1.2 million here, and of course that's the wrong number. We recorded it at 1,250,000. So once again, let me just grab the calculation and pull it aside here. So we reappraised, or we revalued the asset to 1,250,000 as shown in this calculation. So 1,250,000 is the new cost of the building. So we're actually going to take that 1,250,000 and divide that by the remaining 14 years. So that's 89,285.71. Nice round number. And then we need to do the revaluation calculation. So just as we did it up here, by taking the new value minus the net book value of the building to record the amount of the change. We're going to do that again with the new numbers. So our new valuation is 1,400,000. I think that's enough. And I like to put both brackets in and then just back up one. So that's 1,250,000 is the opening number minus this new depreciation we put in this year of 89,285.71. So 239, 285.71, and that's an increase. So if we ever had a decrease in the value, this revaluation surplus that we've accumulated, so we started with 210 plus the 36. If it went the other way instead, we would actually deduct the revaluation surplus. We would reduce the revaluation surplus to the point where it's equal to 0. We wouldn't go the other direction, so we'd have to record a loss if we actually reduced it below that amount. But in this question, we just have revaluation surpluses all the way down, which is kind of good. And of course, now we have to undo this accumulated depreciation because we want to reestablish the cost at the new level of 1.4 million. So we should probably change this so that my description is actually giving us the right information. We're going to use that information in the next journal entry. So let's see how that works in a second. All right, so that's that one. Now let's grab the 31 Decembers and bring those down again. So essentially we've got one more year for doing the same thing again. And since it's going up in value once again, we can pretty safely make the assumption that we're going to have a revaluation surplus increase again. And we're going to record it this time at 1.6 million. Which I think that is, so maybe we don't have enough. No, that's right, 1.6 million. And the building down here, and to eliminate the accumulated depreciation one last time. So here we take our opening cost of 1.4 million and divide that by the 13 years remaining. And so if we look at this one, whoops, look at this one, we have 14 years remaining. This one up here, we had 15 years remaining. So here we have 13 years remaining. Grab, drag, there we go. And then the building needs to be revaluated to 1.6 million. So 1,600,000 minus the previous cost of 1.4 million minus the depreciation we recorded this period. Whoops, I want a bracket. Alright, so it's 307,692.31. So now we have a fairly large revaluation surplus. We have 210 plus 36 plus 239 plus 307. That's a fairly large chunk of change since the beginning. And then of course the accumulated depreciation has to go away. So we grab that and carry it down here. It has to go away. And the offsetting entry to the building cost. So we've done the same thing every time. We have a revaluation surplus increase every time. So we have room to go the other direction if we do need to, if the value of the building goes down. But it's fairly characteristic for real estate in a popular or increasing area, Edmonton for example, where lots of people are moving to Alberta and moving to Edmonton. The real estate prices tend to go up with the increased demand and the limited supply. Anyway, that's the way the revaluation surplus calculation works. Let's see what Lyrics thought of all of that. It liked the first calculations, it liked the second calculations, and it liked the third ones. And we got full marks on that. That's pretty good. 30 marks. There we go, revaluation model. And we're done.